Hey, good afternoon, everyone. My name is John Geminade, EVP of Production here at Angel Oak Mortgage Solutions. I'm joined today by Tom Hutchins, President of Angel Oak Mortgage Solutions. Tom, how are you?
Doing great, John. Good to be here.
Thank you. It's been a couple months since our last market update. So
Yep.
Today we're going to talk a little bit about how the first half went,
Yep.
what the market's showing, the housing market. When we met last, it was all about tariffs, geopolitical strife, and the Fed, and what's changed. Not
What has
much.
changed?
Yeah. So let's get started here, Tom. Talk about our first half results.
I'd call them outstanding.
Mm-hmm.
We had a great first half of the year. Very optimistic about where we're going to be the second half of the year, but it was just some interesting data. We had lots of activity, lots of submitted loans, and you probably know the most important stat of all is our pull through.
Yeah.
We had an amazing run and you share the exact number, but
Yeah, Tom. So we're all about efficiency and technology, and it's just training AEs. And I'm realizing that we're one of the only non-QM lenders out there that actually do pre-quals. And that's a pre-underwrite of your file. So we understand how important that is to you. But our pull-through for the first half was 79%, up from 68% from the first half last year.
that's incredible. I think in any business, in any mortgage sector, whether it's non-QM or agency, 79-80% is off the charts.
It is. And we talked about what are some of the reasons behind that, Tom? And Travis talked about it a little bit this morning. Mm-hmm. Or enhancement.
I think there's a lot of factors. One is, you mentioned it already, we have AEs that do pre-quals, quote, pre-underwrite, and that's what they do. And we've talked about this before, you and I, even on this segment, is that the experience of our account executives is kind of second to none in the industry, not just in non-QM, but specifically with Angel Oak. So I think we have a lot of loyal customers. We have a lot of loyal and expert account executives, and it just makes for ease of transaction, ease of getting loans from start to finish and getting them to the closing table.
Yeah, the average tenure, we mentioned it the last time, is over 6 years here, just at Angel Oak. So they are experienced, and
now it's 6.5.
Yeah. Well, and then you talk about where do you find those, Tom? Because we are hiring, right? We've added 14 account executives in the last 6 to 12 months. So if you go to angeloakms.com and need to find your account executive, please go to that website and say find your AE. So really encourage all of you, if you don't know who your AE is, to reach out to an AE in your local market.
Yeah, absolutely.
So Tom, give us a little look into the second half of non-QM.
Well, there's so many factors. Those issues that you said we talked about last quarter really haven't gone away. I think there's maybe a little bit less concern of the impact that they're going to have on the market, specifically tariffs. I think tariffs was a hot topic a few months ago, but now that there have been some negotiations and some threats have turned into less, I think that's not as big a concern, although now inflation came out actually this morning. It was a little higher than anticipated, which probably I don't think rates were likely going to move anyway, but now they're probably definitely not going to move, at least in 2025. So, and that might have happened regardless of inflation. It seems like there's some personal things going on there between the administration and the Fed. But we shall see. I do think the economy's strong. There's lots of optimism. Housing is still, I wouldn't call it a headwind, but we don't have a tailwind. It's just there's still home price appreciation, affordability, all those factors have not really changed in the last quarter. But to your point earlier, just about our 79% pull-through, non-QM is really weathering the storm. And I think a lot of that has to do with the products themselves. They meet the needs of this current market. And not that we're going to talk about products, but just in general, that's what non-QM does.
That's our tagline on our website is the underserved borrower, right? That's who we're serving. Those are your self-employed borrowers. Those are your investors. Tom, talk a little bit about what we're projecting for the second half and what we usually do historically in the second half.
Yeah, second half is always bigger than the first half. Everybody kind of knows the January, February effect, and we're through that and actually did quite well in the first quarter as well. So I think a little over 60% of our annual volume comes in the second half. So we're pretty excited about where we're going to end up this year, and then again get a few tailwinds behind us from a market standpoint. Some easing of interest rates would help everybody in the mortgage business, but it's certainly going to fan the flames of non-QM production as well.
Yeah, it's amazing how counterintuitive we are toward the agency business because, the fourth quarter for us is usually the strongest quarter for us. So, and that usually gives us that, that run into 2026. We talked about how great a first half it was, and I want to talk a little bit about the opportunity. The Mortgage Bankers Association still only has a 10% increase, so they're doing $2 trillion. They're still anticipating $2 trillion in business in 2025. Well, we talked a little bit about 60% increases year over year. So if you're really not participating in the non-QM market,
you're missing out.
You're missing out. You're losing market share. So there's a great opportunity out there for you.
Well, and the other thing, John, I think that the pull through, don't want to talk about that this whole time, but it also speaks to loan officers that are now experienced in closing non-QM loans. So if you're a first time listener to this podcast or someone who's never originated a non-QM loan, it's not too late, but I highly encourage you to start because we're seeing growth. The non-QM industry is seeing growth, and a very flat, I'd say 10% growth is probably not even going to happen in overall production, but maybe it does. Here nor there, that's still a pretty flat market for the mortgage business.
And I haven't seen a revised forecast, but their forecast for refis was 16% increase over the previous year.
Mm-hmm.
Rates haven't moved.
Yeah.
So I find that hard to believe.
That was baked into those projections for sure.
Exactly. So let's talk about the opportunity. We talked about market share. We talked about, is there still an opportunity out there for originators to grow their business? And what are those opportunities, Tom?
Well, you mentioned it already, the underserved borrower, the self-employed borrower, the professional investor. I heard some statistics about the number of transactions that are for non-owner occupants, for investors, and it's quite high. What was it?
27, the first 3 months of this year, 27% of the purchases were investor, non-owner occupied properties.
Yep.
And traditionally, that number is usually only about 18%.
Okay. Yep.
So that serves right into our debt service coverage ratio. Those borrowers are still getting their market share because they know that if rates don't change, they're eventually going to come down and they can do refis.
Well, another just data point is about 35% of our loans are cash out loans, which you would expect that in this type of market, but on the other side of that is 60% are purchases. So anybody who wants to have a purchase market and keep building a purchase market, you really have to have non-QM as one of your products because those borrowers are out there, and there's more and more. The awareness, even at the home buyer level, has increased greatly about non-QM products. So,
yeah, and we've seen our number one product unit-wise is our debt service coverage ratio program.
Yeah.
And volume-wise, it's still bank statements because those are your bigger loans. Talk about HELOCs, Tom. We touched on it the last time, and we've done some deep dive webinars into not just HELOCs, but all things cash out. And we'll probably do another one next month, so tune it up.
Well, nothing has really changed as far as the amount of equity that homeowners are sitting on. It's at record levels. Credit card debt still remains at record levels. The average interest rate on those credit cards are still 25% in that range. And so, we're seeing the continued growth of our HELOCs. And our HELOCs are made for that non-QM borrower. They're a bank statement HELOC. So we're looking for the self-employed borrower who doesn't want to get rid of that first lien that's in the 3.5%, 4.5% range. They want to keep that in place, but tap into this huge amount of equity that's occurred over the last few years.
I don't want to put you on the spot, but talk about maybe another program rolling out.
Yeah, well, I mean, the DSCR is such a big part of the non-QM space, and we're coming out with a closed-in second lien within DSCR. So even this, so what we're talking about, interest rates and low rates, that applies to investors too. So that's something that's an opportunity for originators to tap into a new market. Not only the future investor buyers, but the current investor owners that want to tap into their equity.
What you have a great relationship with the capital side of our business. What are you hearing from them, and what are they sharing with us?
At the investor level, just interest is at it's very high. It continues to grow, and it has to do with performance. When we started this 12, 13 years ago, we talked about that every single day. We have to originate good loans so that this sector, this non-QM market, is has the longevity, and we've stuck to it, as has the whole industry. So it's not just Angel Oak, but just kudos to the industry. We're all originating good loans, and that's a good thing. And that keeps investors' appetites very high because it's a nice coupon, it's a nice return on investment with minimal risk. So
talk about what you're seeing going forward. Do you see any products, new products other than the DSCR closed-end second? Are you seeing maybe loan amounts?
Well, I think everyone's having to address the loan amount issue because of back to the whole home price appreciation. It's just It costs more. Houses cost more, so loan amounts, we've seen them go up 4 million. 4 million plus. That continues to happen, and I think that will continue. But as far as wholesale or prime, significant product changes, I don't see any. I believe the bank statement loans, the non-owner occupied loans, the DSCR loans, those satisfy the majority of the non-QM market, and so don't see anything like that on the horizon. Just continual improvements.
And as I mentioned earlier, we're continuing to enhance our programs. So maybe not new programs, but enhance our current programs based on the performance. What you said.
Well, we were talking this morning, and we've seen when we were kind of introducing this industry, the non-QM market to the industry. We did a lot of exceptions. We always talked about 35% of our loans were exceptions to the guidelines, and we were really good at it. But right now, I think the last thing I saw, we were around 11% exceptions. Yeah. And it's really not that we're making less exceptions. It's just that we would turn those common exceptions into new guidelines. So we've continued to evolve and advance and improve our products so that exceptions, we still make them, but they're just not as needed.
Right. And the biggest one we just made was 3 months reserves on 90% of our programs.
Yep.
So, if that's ever been holding you back or your borrower back, definitely reach out to your account executive.
Well, I think one thing that everybody is in the mortgage business, non-QM or agency, is what's going to happen to rates. And, I touched on it already a little bit, but I just don't see anything changing. So the people that are waiting for rates to get better, for their business to get better, that's, to me, just the wrong approach to take in this market. I think you have to be aggressive and expanding your product offerings. Back to that 79% pull through. It's because we have originators that have figured out how to find these borrowers, pre-qualify these borrowers, and close these loans with Angel Oak. So, that's the message that I would think everybody should take away. Is it's definitely not too late, but you need to get off. On the horse and go for a ride with Angel Oak, and we're gonna get you, show you a path to grow your income, and that I think is what everybody's looking for.
Another stat we heard this morning in one of our meetings was like all of our loans close in less than 30 days.
Yes.
And a good portion of that close in less than 20.
Yeah. Yep.
So let's talk about efficiencies a little bit more. We touched a little bit about, and you jokingly said, that thing called AI and how we're incorporating technology, not just AI is a fancy word, but technology and efficiencies, from start to finish.
Well, I believe one thing that keeps some originators out of non-QM is they're nervous about the process because it's different than agency. And we've been doing this for so long. We've from day one focused on the process and made sure our process was as easy and efficient as anything that we could do. So our partners could get loans and get borrowers and get them to the closing table quickly and efficiently. Well, now with technology, I feel really good about our process, but with putting in some more efficiencies through AI, people always talk about AI, it's going to replace the world, it's going to replace all the people. That's not how I see it. I see it as just making the steps within the process a lot more efficient. And we're doing that, and we're going to continue to do that. And I'm really excited for some things that are even coming in the next quarter, or certainly by the end of the year.
So Tom, I think it was May, we had one of our best customers come up here. Mm-hmm. So we're always looking for feedback from our customers. Yeah, so
absolutely.
Kind of share how that went, please.
Well, it's always great to hear from customers and get direct feedback, and we're going to expand on that. It was so good, beneficial for us. But I'd say the main feedback was they wished we could close every one of their non-QM loans because again, it's that originator that understands our process, understands our products, works with a highly skilled expert in our account executive, and it's kind of a rinse and repeat. Every single loan goes through the exact same process, and even though the loans are different, the experience is generally the same. And that's, to me, as an originator, that's all you can ask for, is give me a similar experience so that I know what to expect, and more importantly, so that the borrowers can be coached up on what to expect.
So if you're a new originator, you said it a couple times, it's not too late, but what do you think keeps them from?
I think it's just the fear of unknown.
Yeah.
They just haven't done it. And again, I don't think there's as much fear now. I think there's more questions on where do you find the borrowers, how do you market them, and I think that's maybe something we could spend a little time on.
Yeah, we could spend a lot of time on that
Yeah.
Because we do that in those deep dive product demos. We take them to the portal, which I believe is the best marketing portal, not just in non-QM but in lending. And we have flyers, we have social media posts, we have whiteboard videos. Everything's out there. I think I counted it one time. There's about 80 plus ways you could market yourself using all those different channels, whether it's Pinterest, LinkedIn, Instagram, everything, the flyers. You could build a non-QM campaign
every
for
day.
a year and a half.
Yeah, every day.
Yeah.
Right.
So that opportunity, I believe, is still an opportunity out there. I know we talk about new business applications, over 400,000 a month, and that has not slowed down.
It's probably
so
going
that's your
to continue
self-employed
to grow faster, probably.
Right.
Yeah.
And that's what we do. We calculate that income for you. We do it at the pre-qual stage, and that's what makes our account executives the best in the business. But yeah, it's just still a huge opportunity. We talked about the investor out there. 27% up from traditionally 18% of the purchase transactions out there are investors. They're not afraid to continue in this housing market. So anything else, Tom, you want to share?
No, I think I don't want to beat a dead horse.
Yeah. Sorry.
That's fine.
We have a question?
Yeah. Go ahead.
Yeah. So we had a question come in here, and it's around DSCR. I think what we're seeing here, DSCR. I know this isn't a product webinar, but with you guys here, the question is, do we offer DSCRs that are negative cash flow? So I guess those below, 1, maybe
below the 1-to-1 ratio.
Yeah. So maybe talk a little bit about the
0.8
DSCR program and.
Maybe high level quickly. Go ahead.
Yeah, so we do go below the 1-to-1 ratio, as Tom just mentioned. We'll go down to a 0.8 ratio. So if the house isn't cash flowing properly, we'll still go there. And then we even go to a negative cash flow. Now that'll be a reduction in LTVs and just risk based on that. And we also just another.
So really, you call that a no ratio,
ratio.
Not a negative.
Right.
So if it's below 0.8,
thank you.
Then we don't even calculate. We no longer use the ratio.
That's correct.
Yeah.
So great question, but that. Like I mentioned earlier, that debt service coverage ratio program has become our number one program, and beating the dead horse.
Yep.
It's because that investor is continuing to invest.
Yep.
Any other?
Yeah. So another question that came in, industry wide, what percentage of purchase business overall is non-QM now? So maybe that's kind of also just.
that's a hard number to get to from an exact standpoint, but we can look at securitizations and all that, and it looks like non-QM is a little under 5% of the originations currently. That's kind of accounting for not all non-QM loans get securitized.
Correct.
But we believe, and we've believed since we started this, that 10% of the market is the right number, and that's where we should go. So even if this mortgage market stays flat, we see non-QM doubling over the next couple of years. So 10% is reasonable. We don't have to expand our guidelines. We just have to continue to educate and make loan officers aware of what the products are and where these borrowers are and how to find them.
And continue to build efficiencies into our business too, and we're
Absolutely.
doing that. And
Yeah.
as Tom said, we're really excited about what's coming down the road from a technology and an efficiency process. So, any other questions?
No further questions at this time.
Well, Tom, thank you for joining
John,
me.
my pleasure,
I appreciate
always.
everyone. Again, John Geminade, EVP of Production here at Angel Oak Mortgage Solutions. Thank you for joining us today. Have a great afternoon.
Thanks, everybody.